So what do you want to start with, Bank of Canada?
I think Bank of Canada, I mean, we've just gone through this, just a couple of weeks ago, the Bank of Canada met, and I was shocked.
Yeah. Well, by the full basis point.
Yeah. Well, everybody was planning on 75 basis point increase.
Yep.
And when it was 100 basis point, obviously we were scrambling a little bit. We had all our collateral ready. Our producer here, Jonathan Snow, he also does all our operations, technology, marketing things. And we had everything ready to roll as soon as the Bank of Canada met. We were watching it live.
Yep.
And I actually watched the first bit of the newscast that the Bank of Canada governor did when they did the 100 basis point increase. And I think we're all pretty surprised. Yeah. Obviously,
well, you said you were shocked.
I was shocked because, people were kind of saying, 75 basis points would be aggressive. Maybe some people thought it might have been 50. And when it was 100, we were like, wow, these guys are serious.
Yeah.
And
for those who don't know, this is not an economic show per se, but economics plays a big role in this.
Of course, yeah.
So the whole point of people might go, why you got to raise inflation or the interest rate? It's all about curbing inflation. Can you explain that?
Yeah, because when they increase the cost of borrowing, what that really means is a lot of households are going to spend more on interest, whether that's mortgage interest or maybe interest on unsecured debt, businesses. Right? Yeah. They're all going to spend more money. And what they're trying to do is to get consumers and probably businesses to stop spending as much money and start hoarding cash. Right. So, artificially, that kind of really happened during the pandemic because, we were all locked down. Canadians really didn't haven't saved as much money as they did over the last couple of years because they weren't going out to eat and buying consumer goods and all these things. And then when things started opening up, people had so much, available cash, we'll say, it kind of flooded the market. And, there's been a lot of supply chain challenges.
Yep. That's easing, I hear.
That's easing a little bit. And, the inflation numbers came out in July. And even in Canada, inflation was about 8%. And the Bank of Canada governor said that they think that we might even see a little bit more increase in the inflation before it starts softening. But they're thinking the inflation is going to start coming down here by the end of the year. Right.
Okay, so that's the purpose of raising inflation rates. So the bottom line is you were shocked, though. You weren't anticipating. Do you have any opinion on whether it was too aggressive or not, or what are your...
I would say the Bank of Canada gets it right about 0% of the time.
That much?
0%.
We could give them 10%.
Well, maybe 10%.
Sometimes you luck in. Everybody gets 10% luck factor.
And there was an article that came out either before the Bank of Canada met or just afterwards, and it said every time there's been an increase like this, within 13 months, they start lowering the key overnight rate again because, we get into a recession situation.
Yep.
So it's turn the dial up, turn the dial down. Turn the dial up, turn the dial down. The problem is that, right now, obviously, inflation was a bit of a runaway train, and they're trying to get that back in line. Maybe they were too slow at kind of increasing the key overnight rate, and things kind of got a little bit out of control, so they're trying to get that back. And they use this term called soft landing. Yeah. And... I think what they want to do is they obviously want to increase the cost of borrowing, but they don't want to cause, a massive recession. So they want to slow things, bring the inflation down. The target is 2-3% is where they want the inflation. And, we are almost triple that right now.
All right. So let me ask you this question. You had a lot of clients, I'm sure, a lot of people, not only your clients, but people in general purchasing. And it's almost as though they didn't realize that this was going to happen, that interest rates were going to go up. And
I've used the term before, Canadians were drunk on cheap money.
Yeah.
I think it was low for so long.
Yeah.
And here's kind of the interesting fact. Pre-pandemic, the prime rate was 3.95. Today, it's 4.7. It's not that much higher.
Yeah.
But I think it was just so low for so long that... we forget that variable actually varies.
Yeah.
And, what goes up must come down. And, we enjoyed some very low cost of borrowing for quite some time. Now it's costing a little bit more, and it will balance out. I'm in a variable rate mortgage myself, Todd.
Yep.
And I believe historically about 60% of Canadians are in a fixed rate. We're pretty conservative overall in Canada. And typically in a fixed rate, you're paying more to have that security. And I think if people are right at the top of their budget, if there's issues around affordability, there's nothing wrong with a fixed rate, Todd. But if you can take a little bit of risk, typically you will get the return with the variable rate. Historically, it is lower. I believe it's going to come down in the next, 12 to 18 months. And those consumers that are feeling a bit of a pinch, there are solutions. Maybe it's a solution around extending the amortization, or maybe it's a solution of doing a midterm refinance, maybe pulling some equity out, maybe you re-amortize the debt. And here's a little interesting tidbit. There's a lot of Canadians that have home equity lines of credit, a HELOC. We use the word HELOC quite a lot. We are paying out a lot of HELOCs into amortized charges. Typically, a HELOC, the rates are at prime plus 50 basis points. So right now, people with a HELOC, a lot of people are paying about 5.2%. And, in a refinance or even a transfer situation, if you just take the debt and you don't add anything to it, some consumers are getting like prime minus 95 on an amortized charge, like over 25 years.
Right.
And the difference in that rate is almost 1.5%. And HELOCs sometimes are forever. People, aren't great at paying it down. Obviously, if it's a savvy consumer and they're using it for investment purposes or something like that, I think it's...
Or just as a contingency.
As a contingency, I think that makes sense. But a lot of people who had home equity lines of credit over the years, and they certainly were popular like in the 90s and the early 2000s, they use them and then they're just paying the interest. So a lot of our consumers, or a lot of people who are coming to us, want to pay out these home equity lines of credit, and we're putting them into an amortized charge, which I think is pretty interesting.
Yeah. Well, look, people they need to hang on, right? If you're tight, like you said, sometimes you get to rein in your spending.
I think you certainly need to rein in the spending, and I think when we're back, we are going to talk a little bit more about wants and needs, and really, what does that look like?
That's the segue, almost like we knew what we were doing there, right?
Imagine.